Hi, Vish. Welcome to BizTalk. That's my great pleasure having you today with me. How are you?
Yeah, thank you. Thank you, Max. I'm well.
Thank you. Thank you for coming. So let's talk a little bit about yourself before we jump into the business.
I'm 49 years old. I founded this company in 2018, Strategic Ratings. I have background in engineering, management, and credit ratings. And as of now, we have applied the license to FCA for operating as a credit rating agency in the UK. And in future, we intend to expand this business to other countries. And we are a team of 29 people right now in Strategic Ratings UK.
Okay. So let's talk about the business. I understood that the business is in the credit sector.
It's in credit rating sector. Yes.
Yes. So let's talk about a little bit of your business, when you establish and how things go.
When I was myself as a retail investor in stock market, and from my family background also, we came to know that it's a lot of hassle to find out how the stock is going to do. When you select the stock picking as an investor, you want to have some sort of reliable information before you do your own due diligence and assessment and evaluation that how the stock will do. So that is when the seeds of this business are, from long-standing experience, that okay, we need someone who can provide a reliable information. Obviously the existing players are there who have their methodologies and rationale, but when we did the research, particularly on credit rating domain, we came to know that there are basically two kinds of issues. One is an administrative issues about who pays how much and why, the particular business model part. And the second part is that, okay, if we go deep down into the methodologies and the quality issue, that how can you pinpoint or how can you be more accurate or precise that, okay, this is what I measure to assess this equity or the debt issue and so or the project. Credit rating can be given for many different purposes. So you want to make sure that what you measure, how you analyze, how you interpret. So this all leads to one single problem, that okay, the quality of the rating, you can give it to someone and issue and so on. And even an investor can request a rating that okay, I want rating before I make an investment. So how you can be sure of having a good quality, and how you can be sure of taking a right price for that quality. These are the two issues. So that is why we thought that there should be some solution to this. And if we can provide that solution in the market as an independent or a niche agency who will work on a small scale, not kind of a factory of the ratings, but be more realistic to maintain the quality and administrative issues part. That's where we founded the strategic ratings in 2018.
May I ask you how different you are from the measure, which everyone knows?
As of now, we are not launched in the market, and we are in the process of obtaining authorization. So we won't be able to disclose that on what grounds or what are the bases of our differentiation. But soon markets and the competitors and the investor community and other stakeholders will come to know that how we are different and why we are different and why we are better probably compared to the other more than 20 existing agencies worldwide.
Yeah, there are many, and I have to be honest, I'm not that. Yes, I mean I trust them, but there is some kind of bias when they rating, right? Especially when if you are rating states, debt, and whatsoever. But in your case, which exactly asset are you going to rate?
We are going to be in two sectors. We are going to be in listed corporates who are stock exchange listed and publicly traded companies, and the sovereigns. Now, these two are major sector. Like with corporates, you can have their subsidiaries or other turnkey projects or other particular debt issuance, or with sovereigns, you can have other projects or sub-sovereigns or other debt issuances. So these two as a major categories, but there are subcategories into that. There could be a short-term rating, long-term rating. There could be a private assessment, confidential rating, and other divisions of those. So it actually still makes a big portfolio, even if you cater only these two as a major entity sectors. Yeah.
I mean, when foreign, okay, sovereigns, but regarding companies, how you're talking about only listed company, right? You are not going to rating any unlisted private company.
No, through strategic ratings, no.
Okay. And what
When
about?
you obtain an authorization, you have to be very specific with the regulator that which sector you are going to use this authorization for. So that authorization is only specific for that particular sector. So if you say them that you are not going to do ancillary activities, or I'm not going to rate any structured finance vehicles or SMEs, then you cannot do unless you change your authorization. So we will be only going for these two, listed companies and sovereigns right now.
So sovereign and listed on the stock market. Are you going to cover worldwide or specifically some region?
Specific. Slowly we go from one country to the other country. So it wouldn't be worldwide in one go. No.
Where do you start with?
We start with the UK.
So you're based in UK?
Yes, the parent company and the first subsidiary both are based in the UK. We have a parent company which is called CEO 24/7 Limited, which will be holding all subsidiaries and licenses and IPs. That's in the UK based company. And the first subsidiary which we want to have an authorization from FCA UK, that's Strategic Ratings Limited UK. That's also UK.
And you have already your roadmap where you're going to after?
Yes, we have. That would be another biggest market, and where I come from actually in my origin, that would be India. Second would be the Indian market. Yeah,
it's a huge, massive market.
Yeah,
me personally, I believe more in India on the long term than China. That's of course my personal opinion.
It's a massive market, and basically, if you look at the history, then the Indians were very big in a trade. 400 years ago, they were contributing more than 20% of GDP worldwide. So they were actually doing good business. But slowly the technology took over, and then they went down to 2-3% contribution to GDP. Now again is going to be coupling back to that level. So obviously, when you have more than 4,000-5,000 numbers of companies listed on just one stock exchange like Mumbai, you expect a big business there. If you are in just one space of listed companies rating, that's a big market to just cater one space here.
It's huge. It's a huge market.
Huge. It's a huge.
We talk about more than 1 billion people, so 1 billion people can only create a huge market in terms of companies. I mean, companies just work in the domestic market. The market is simply endless. So you seriously have a lot to do. What about you started in UK, and when you start your company?
We registered the parent company long ago because we were already in the process. But then we came to know that we have to separate out. To get an authorization, you must have a separate entity who is not doing anything else. So just for that purpose, we founded Strategic Ratings in December 2018.
You established the company?
Yes, both companies are established. Yeah. No.
What's the stage now? Still yourself? You have 49 people working?
No, not 49. 29.
29. Sorry. Yeah. And how the company is structured now? You have your board of directors?
Yes, we have board of directors, we have employees, we have our chief technology officer, chief ratings officer, chief executive officer. I, as a founder, don't deal directly into the rating process because I got a commercial stake into the main company through my parent company. So it's a conflict of interest, and regulator says that founder cannot directly involve in a rating process. So I can involve in an investment process. So I can deal with investors or a sell process on the front end. I can be, but I cannot be involve myself in the rating process. Not any of the founders or major shareholders. No. Not even the CEO. He cannot be in a rating process. No.
Okay, that's smart.
Yeah. It's a clear separation between who sells the rating and who derives the rating. Clear wall between them. Yeah.
That's important. Absolutely important.
Yeah, it's very important.
May I ask you, rating can be very questionable. And what about, in your opinion, what is wrong now? Because there is something wrong. I can say there is something very wrong, broken when
It-
it comes
it-
to
yeah.
rating, especially sovereign. There is something very broken.
Thing is, investor want, let's say if we go by stakeholders, how many parties are involved in, and then you will understand where the problem is, because then you put all of them into one mix in a bowl, you will understand what's the problem. So investor wants to invest only where there is a higher return and a less risk. A regulator wants to allow the investment and a buyer to trade where they don't broke the market or the economy is stable. The person who gives the rating wants to make sure that he gives the right rating to investors, that investor buys the rating, and the person who is issuing the debt wants to make sure that he has got a proper rating so that he can go to the investor and get the money. Now you come down to a puzzle where one wants to catch, another wants to leave, right? So you have a debt issuer, you have an investor, you have a rating agency, and you have a regulator, and you have some retail investors who wants to make sure that if they are not a big investor, they don't want to lose their money, right? So there are institutional investors, there are high net worth individual investors, there are professional, sophisticated traders investors, there are analysts, and there are investors who are ready to buy some 100, 200 shares from a trading terminal, right? So how you satisfy the investment community, how you satisfy the debt issuer, how you satisfy the regulator, how you make sure as a rating agency you satisfy all three of them, and you are still charging the right money. So now when you put all that into one single mix, you realize that if they don't do their, any of them, they didn't do their job properly, then it's going to make the system not work properly. Yeah.
Yeah, I mean, I don't want to say it's not working now, but it's
No, it's working. It's working. Everyone is doing their job. Everyone is striving to do their
You're
job
right.
perfectly. But still, in the output section, we realize that, okay, there is something wrong. So sometime we receive the news or the results or the ratings that, oh, this could have been avoided or this could have been prevented. We end up to the output part. Input is okay. Everyone makes sure that their input is perfect, but still we don't receive perfect output. So it means there is something somewhere.
Yeah, exactly.
Yeah.
This is what I was just telling now. It's not broken, but it's not for sure working properly, right? Now, what I always have been asking to me is why all ratings are based on that. We all know that that is bad, but it's not that bad, right? So if that ratio is very high, you have a very bad rating probably. It is no matters what. I mean, you can be company, you can be sovereign, you can be a state, wherever you are. That matters a lot, right? But now, let me talk a bit about something different, which is politics. And this is what I can't say upset me because that's the reality, but that ratio for the states is not the same that ratio. I'm Italian, from Italy, for example. Of course not. America has such a high level of that, but they still get a very high level rating because politics matter. That is the point, right? And unfortunately, or fortunately, I don't know, company gets the same rating as where they are reported, right? So I think this is a bit broken. I think if I'm American company, I should not get rating even leveraged of American state. And I'm not sure that because I'm America, I'm not against America, absolutely not. Actually, I love America. I'll just give an example. But at the same time, why? Because I'm so strong politically, my rating has to be strong as well, although my ratio between debt and GDP maybe is very, very bad. It grows over the roof.
Rating agency in a nutshell is kind of an auditor. So if you have, even if you had a good reputation, let's say I give you an example that someone is a big investor and he got a very good reputation, but if his bank account is broken, his auditor can only give him some level of certificate that, okay. And if it goes to bank, bank can say, listen, if you have only 10,000 pounds in your account, we can give you probably a bank account, bank guarantee of maximum that if you maintain this 10,000 in a lock in a fixed deposit, I can going to give you a letter that bank guarantee or letter of credit is for 10,000 pounds. But if you are not trading from the last 3 months, bank might refuse that. Listen, I can't give any letter of credit because you are not trading and the only thing you have is 200 pounds. Even if you were a very big short person 3 months ago, or you are going to be a big short person in future, the auditor or a bank or a rating agency can give rating only with what is on the hard facts on the table. So it's not about any get politically motivated or you have something wrong. No, you cannot do like that. It's all about what data is in front of an analyst, how they are analyzing it, what is being measured, what is being discarded. And all you are looking in giving a credit rating is basically whether that person is going to be able to service his debt obligation or not. That's all is about. How much risk involved in giving the credit further and how much risk involved in what is already big credit being used. So your credit risk measurement, from that credit risk measurement, you will go to credit rating and you will interpret and you will write your rationale and methodology. Listen, this is what data we had. This is what we calculated. This is what is possible. And from what is possible, this is what the rating we can give. There is no other extra influences or any other viewpoints or nothing is considered. In business profile, you are probably some qualitative factors, some quantitative factors. How much is the risk? Can he service entire debt? Can he service not entire debt? What are the chances of person or the company or organization defaulting? After all, even if you take a company, you have a bank accounts. If you take even as a sovereign, you still have your trade balances and your whether you have how much is your income and how much you are producing and how much debt you will service. That is all about what is foreign exchange reserve you have. So it's all about finally whether you consider entity as an organization or entity as a country or entity as an individual person. What you are finally evaluating is credit position, whether it's risky or not. That's all.
I mean, absolutely agree.
So as far as they can service their debt. So now we come back to America, that if they can have a 16 trillion debt and if they can serve 16 trillion debt, rating will be still high, even if the debt is 16 trillion. As far as they can pay off that, their position is strong that no, I can serve this debt. That's fine.
This is my point, right? I've been always saying, and we always say, always, until my day will arrive, my last day, the debt is bad only if you can't pay.
Yeah.
More than that, when it comes to sovereign, you only need to pay interest because everyone knows you pay that issue, other debt, you pay that issue, other debt. And that's well known to everyone. When it comes to company, that's a different way to go. But still, that is not that bad as it looks like, right? Now, my question is, it's very fascinating because I love this topic. And how connected are auditing with rate agencies? Because many times I see company, even in UK, and we have many examples in UK, building companies, state-owned, collapsing the day after. So you got maybe 250 million credit line from the bank because your rating is triple I, and you collapse the day after. That's a big problem. How come? This can happen, right? So how this can be fixed? Because it has to be fixed.
When you analyze data, earlier there was no technology involved in this, but now because of the AI and machine learning development is there and the technology is there, the speed with you can analyze the data, the speed with which you can analyze the massive scale of data, or the speed with you can forecast, or the speed with you can get the information from the internet. This is all changed. All this equation changed because of the technological advancement. So earlier, probably if you ask someone 50 years ago to do the data analysis of same data which you can have today, it's not possible. So today what iPad can do in 10 seconds, your 100 million computer could not do it in 6 months, over the 6 months, 60 years ago. Yeah. So you have now, earlier you were supposed to invest 100 million to do that much computing, but that computing can be done with 700 pound Apple iPad today. Yeah. So that has changed. That's the one thing, one dimension. If we take technology, that's a game changer. That okay, you can do things more accurately, more precisely, or more faster. So that's one thing helps. And second thing is that when you analyze someone, we come back to same qualitative issue, that what you are measuring, what you are analyzing, how you are interpreting, and how far you can forecast accurately, because it's still a prediction. You are still making a prediction that this company or organization or this person will default or not. You are still making a prediction. There is no surety how much probability you can attach to that, whether this will happen, this event or not. It still go down to the calculation. So I feel that the case which you explained, that okay, if someone has a 250 million credit line and is going next day bust, I think those days should be over, because it wouldn't happen if we are able to forecast, predict, or monitor someone by minute to minute. Then it wouldn't probably happen. Yeah, that's where the technology will help you, or the understanding or looking beneath the data. That's what we intend to do. That we look beneath the data. We just don't look at the data. We look beyond the data. Yeah.
I mean, I do believe we have so much technology that can help us now to monitor second by second, right? So monitoring second by second, I should know with the banks, even any pound you have been receiving for the last second before you go bust, right? So it's very complicated even to understand how this can happen, right? Because now everything.
Who has the access? Who doesn't have the access? Where is the contractual obligation? Where that money will be used? Whether the 250 million credit line is sufficient or not? What's going to extrapolate into their obligations? Those are the things still people don't know in the community. The investor might have access. The regulator might not have access. Auditor might not have access. Probably the internal auditor, the internal team to the company knows. Maybe the credit rating agency doesn't have any access of that. If the data is not given to someone, if I'm analyzing a client and if I am not given any data, how can I predict or forecast? I'm not going to change your rating if I am not given, or the material information I don't have, which is already changed drastically? Then there cannot be made any prediction or forecasting on that.
This is why giving credit ratings to public company should be easier than to private company, because private company is very complicated. You never know if they actually are telling the truth, or they're just trying to make up everything to get a better rate. I mean, how do you think it should be discounted in rating external facts? Like, for example, when COVID came to play a major role and has been disrupting and destroying very much our economy. Do you think, can we create a model where in somehow we can predict, not COVID, because I don't think COVID can be predicted, but external, right? Even that we can actually manage more than protecting ourselves. So how can we discount this? Politically, for example, or any kind of climate change? Should be climate change, for example, taken into account, I think so, into the rating system now?
If it was already pre-COVID, if all your frameworks or the analysis were considering climate change into it, or considering any unforeseen event into it, or considering that if our profit falls from that to that level. So if they were already stress tested, the frameworks pre-COVID, when you put the data of the year of the COVID, it should already taken into account. You don't have to make a new framework, because you already had a framework which takes into account unforeseen events like flood, earthquake, complete wipeout, climate change suddenly. So if it was all included in that how much this can go down or how much this can go up to limits of going bust or going superior, all of a sudden you find something which makes your profit go 100 times, or you hit something where your profit goes all of a sudden zero, like an oil explosion which happened for BP all of a sudden. Yeah. So your money goes suddenly down. Yeah. All of a sudden the stock price of the money goes down. or you found something like an Apple's iPhone, and okay, you take the industry by storm. So suddenly your money goes up. Yeah. So it should have been already taken into account, isn't it? The framework. So if the COVID happens, so what happens post-COVID is that if you feed that data, so if you are looking at 2017, 18, 19, and then now you will be looking at 2017, 18, 19, or let's say shifts from, if you are looking only at 3 years, let's say, so 17, 18, 19, now you will be looking at 18, 19, 20. So it's taken into account. The effect is already inbuilt, right? So that will automatically change, or it will take the effect into the account that, okay, 18, 19 was high and 20 suddenly dropped. So that drop will be taken into account. You don't have to again change your entire framework for that if it already taken into account.
Yeah, I mean,
and then also if it is relative to the industry, let's say that, okay, if my profits are relative to my industry, so industry's level also drops down, right?
Absolutely.
So your obligation also goes down. With your profit margin goes down, your obligation goes down, the level of industry's income also, the production goes down. So everything goes down, right? If it is relative, is also taken into account. If it is not relative, is already taken into account in your data. And beyond that also, if you want to discount, you can still apply some sort of discount factor to it and still say, okay, we revise this to this level because now we want to change this stress testing. We never had this event earlier where suddenly everything goes standstill, zero, let's say. Yeah. The production goes zero, not a single car sold, 10 million car park, right? all cars are in the on an airport. You are producing and putting in airport, producing and putting in airport, but nothing's getting sold. So let's say you didn't have a framework where it accounts that no sell on 6 months, zero sell, right?
It's not profitable.
Your worst case scenario was you are producing 15 million cars and you will sell 1 million. Now you have to plan your worst case scenario as you will produce 15 million and you will sell zero.
It is.
You might have to amend for that worst case scenario part in the framework. You might have to amend it to zero.
It is indeed. It's fascinating. Yeah. You're an entrepreneur. Where do you see your company? What's your vision for your company next?
Yeah, I was going to compare that if it is a country like America, you ask, do you want to give an equity partnership or you want to issue debt? They will say, no, we don't give you equity partnership in our GDP. We give you debt. You give me the money, I repay you back, right? You go to another multinational enterprise listed on the New York or London Stock Exchange. You want me to give you equity partnership? No. Our stock price is $700, and if you want to buy, you buy from open market. Otherwise, give me the debt. But come down to the entrepreneur who has a, let's say, no pre-revenue or pre-trading stage, and you say, do you want 10 million debt? And he said, no, I don't want 10 million debt. You become the equity partner, right? So the equation changes. If it depends on if you are a country, if you are a listed, if you are a sole enterprise, if you are a SME, or if you are an entrepreneur with an idea with a zero revenue, you want an equity partner because you don't know whether if you take a 10 million as a debt from the bank, absolutely, you will be able to service that debt or not. And that country knows that even if I take a 16 trillion debt, I'll be able to service that debt, right?
Oh, yeah.
So the choice is always between equity and a debt, but entrepreneur would prefer equity. An organization like sovereign, big sovereign or multinational would prefer a debt.
All the life to that. There's nothing to do. Where is your company in 5 years' time? What's your vision for your company as an entrepreneur?
Our vision is that it's already, it was on our website. Our mention also is in investment deck that our vision is we will be operating in next 6 to 7 years in 50 countries worldwide.
So you want to become a global company next 5, 7 years?
Yeah, 7 years, by probably 2027. End of 2027 or start of 2028. We should be operating in 50 countries. Yeah.
Let me close with this one. And what's going to be your contribution to the ESG impact if you have already thought about this in the coming years? How can a company like yours, for sure, giving ratings, can contribute to have a better world?
we will already consider in our rating this ESG parameters. So as a rating agency, that will be our contribution, that we also analyze and we are able to provide ESG ratings and consider that into our framework or analysis or methodologies. And as a company, we try that even if we are a team of 1,000 or 2,000, we try not to travel and have our own carbon footprint as minimum as possible. That is our own contribution as a company to the climate change, that okay, let's try to put our carbon footprint or energy footprint as low as possible. And in the output we deliver to the industry, we try to consider that as one of the major consideration into that. So we will contribute either way, we as an organization and we as a delivery to the community, both.
I do believe credit agency and banks or land providers, they can play a serious role.
Yes.
Serious role. Chris, I can only thank you for coming to BizTalk. It has been a very great pleasure talking to you, and I hope we can have another one later on.
Sure. Thank you. Thank you, Max. I really appreciate your help. Thank you.
Thank you. Have a good day.
Speak soon.
Bye.